All right, guys. Last lesson in chapter 2. We're going to be looking back at analyzing transactions that affect owners' equity accounts. Kind of, again, similar to the last lesson, this is a review of sorts of chapter 1, but we're adding that component of asking those 4 questions. What types of accounts are impacted? What is the classification of each account? What is the increase or decrease impact on each of those T charts, T accounts? And then finally, where do the debits and the credits go? So we're going to be doing the same thing. I'll try to make this one a little shorter than the last one, but again, fast forward or rewind as much as you need to help you. So let's dig in. Again, it's using the same stuff that we kind of looked at in chapter 1. Transactions affecting owner's equity are things like revenue and expenses. All right, so when you sell something and you get cash for it, or if somebody owes you money, you can count that as revenue. That has an effect, as you kind of see here. There's different types of effects on owner's equity. Revenues always increase owner's equity. Expenses, when you spend money on things like supplies and all that kind of stuff, it would decrease owner's equity. All right, investments, like capital investments from Michael Delgado, the person, into Delgado Web Services would be a capital investment that would increase owner's equity. And withdrawals, if Michael Delgado, the person, withdraws cash from his business, then you count that as a withdrawal, and that would decrease owner's equity. So this is just a little review from chapter 1, but these concepts we're going through all deal with owner's equity, and then they're going to deal with other types. They're going to deal with asset accounts, possibly some liability accounts as well. But we're going to be doing the same thing that we were doing in the last lesson, in lesson 2.2, applying those same 4 questions to each of these transactions as we go through. So you receive cash from sales. You make a sale. Delgado Web Services designs a website for a client. That client pays them. They receive cash from sales in the amount of $1,100. So question number 1, what accounts are impacted? Cash and sales, because remember, we're dealing with the sales account. That's a type of account, an account name falling under owner's equity. And we're going to deal with a cash account. How are each classified? Cash is an asset. Sales is an owner's equity account. Question number 3, what happens? This is chapter 1 review again. What happens with the increases and the decreases from a transaction such as this? So when you receive cash from sales, you received cash. So break it apart that way. You know cash is going to go up because you received cash. And remember, when you make a sale, that increases owner's equity. You can go back to that first slide that I showed you, that review slide, and look at that. Bringing in debits and credits. So it's that same idea, just to go through it again. We have assets on the left side of the accounting equation. We have liabilities and owner's equity on the right side of the equation. Looking at an individual T account, doesn't matter which one. Debits are always on the left. Credits are always on the right. All right, so that's it. That's our definitions of debits and credits. That's what you need to know. Debits on one side, credits on the other. So when debits increase and when they decrease depends on what side of the account it's on. So one trick to kind of remember that, assets are on the left side of the accounting equation. Debits are on the left side of the accounting equation. So debits increase. All right. Liabilities and owner's equity are on the right side of the accounting equation, right side, and credits are on the right side of a T account. And so credits increase on the right side of the accounting equation, whether it be a liabilities or an owner's equity account. All right. So bringing in question number 4 for this transaction. How are we going to do this? We know when we receive sales from cash, cash increases. So how do you increase cash, an asset account? Well, you have to debit it because debit's on the left, assets on the left. That increases. That's our normal balance, all right, on that side. So we're going to debit cash for $1,100 to increase it. Our normal balance goes up. Normal balance over here. We're going to credit the sales account for $1,100 to increase it. Again, keeping our both sides of the accounting equation equal here. All right, both sides equal at $1,100 per. Next transaction, sold services on account. So one thing to remember from that Unit 1 review, when you sell your services, that's revenue. It doesn't matter for an accounting purpose. It doesn't matter when you actually get the cash. All right, so in our last transaction, they received cash from sales. So that's an easy way to think about it in terms of revenue. Like you made a sale, you got the money. All right, that's revenue. However, you don't always need to actually get the cash in order for it to count as revenue. You can count it as revenue when the sale happens, whether you get the cash or not. So this one, you sold services on account to Main Street Services. You performed a service for them. They now owe you $500 is basically it, but you're going to count that as revenue. So question number 1, which accounts are impacted? We have accounts receivable, which is an asset account, as you'll see in question 2. And we have sales again, which is an owner's equity account. Question number 2 there, kind of what I just said. Accounts receivable is an asset, meaning that Main Street Services owes Delgado Web Services in this sense, and then sales belongs to owner's equity. What is the increase and the decrease? We know that when you make a sale, your asset is going to go up. So your accounts receivable, again, this is just like you saw in chapter 1, the asset side is increased and owner's equity is increased because sales is a revenue that affects owner's equity. Bringing in debits and credits. How do we increase our asset account? Well, we need to debit our asset account by $500, and then to balance out our accounting equation, an equal side of the, or on the other side of the accounting equation, we need to credit the sales account to increase it. All right, so debits increase assets, credits increase liabilities and owner's equity. Next one, on January 12th, paid cash for communications bill for cell phone and internet service. So we kind of have almost a new account title here we haven't come across before, still within that owner's equity. So again, you're seeing kind of sub-accounts and then sub-accounts of sub-accounts, but don't be deterred. It's the same exact thing that we're seeing here. So let's break it down. Question number 1, what accounts are impacted? Well, whenever you pay cash for something as a business, you know your cash account is going to be affected. Now we're going to introduce this communications expense. Remember back to our chart of accounts? Well, communications expense is one of the account titles that Delgado Web Services gave itself when they were setting up their accounting system. So we know that our accounts that are going to be impacted are cash and communications expense. Question number 2, classify each account. Cash is an asset. Communications expense is an owner's equity account because expenses belong to owner's equity. Number 3, assets are decreased. All right, so you're paying cash for something, which means your cash account is going to go down, and you know owner's equity is decreased, but expenses are increased. So let's look specifically down here. Let's not worry too much about that because you're kind of, I don't know, that's sort of confusing, but let's leave that for right now. But these are the 2 accounts that we're working with, so let's just focus in on those. So owner's equity, while it is decreased, expenses are increased. So expenses are increased. Question number 4, bringing out those debits and the credits. Well, when you pay cash for something, you need to decrease your cash account. So we need to credit cash because credits decrease assets. And then we need to increase our expense account. So our expense account is increased by $80. We are going to debit our expense account there. All right, next one, received cash on account. So you received on January 16th, Delgado Web Services received cash on account for Main Street Services in the amount of $200. Which accounts are impacted? Well, when you receive cash, you're going to be working with the cash account. And then you're also working back with that account that we saw earlier, accounts receivable, Main Street Services. They are both asset accounts. So what happens here? We need to, number 2, how are each classified? They're both asset accounts. Number 3, What is the increase and decrease effect of this transaction? Well, when you receive cash from something, you know that your cash account is going to go up, and you know that accounts receivable is going to go down because Main Street Services is paying off part of their bill. So how do we debits and credits? How do we build those in order to increase cash? Because remember, debits increase assets. I keep saying that over and over again, but try to memorize it because it makes this whole thing a little easier. So we need to increase our cash account. So we were going to debit our cash account there. So cash is debited by $200. Accounts receivable needs to go down. And so we need to credit accounts receivable. Paid cash to owner for personal use. So this is a withdrawal. We know that that impacts owner's equity, and it's also going to impact cash as well. So again, you see the sub account again, but let's just focus in on the two accounts that we're working with, which is cash, because Michael Delgado, the person, is taking cash out of the business for personal use. So cash is impacted. And then the Michael Delgado drawing account, we're going to call that his withdrawal account. That's the account that he can take money from. That is going to go up. That is going to go up. So we have cash and Michael Delgado drawing as the accounts. Cash is an asset account. Delgado drawing account is an owner's equity account. The effect of this transaction, we know that when you withdraw cash, you pay cash to the owner, so your cash is going to go down, and then owner's equity is decreased because withdrawals are increased. Again, I think I'm going to leave that for right now. This is not going to hurt you too much on this assignment that you're going to need to do, but I will go through these more detailed ones. But let's build in this first, and then I'll kind of explain that. So what happens here? Question number 4, and we know that our asset account, when you pay cash to somebody, our asset account needs to go down. So we're going to credit cash for $350. And Michael Delgado drawing, that account is debited because it needs to go up. All right. So the reason why you have this sub account here, and you need to know this, is because it goes back to the idea of keeping both sides equal. So we saw this once before. So if we had just, if we cross this whole thing out and we're only working with these two, well, here you have cash going down, so you have a negative 350 on this side, and then you would have a positive 350 on this side if debits increase. That would not be equal. So we can't do that. So that's why this is a sub account of this one. The impact of this does decrease owner's equity, all right? Because we are debiting it. We're going to debit this account, but a debit on this side of owner's equity does decrease this account. So the reason that you need to think about this a little bit, and again, this will make more sense later, is keeping both sides of the accounting equation equal kind of in your own mind. But for this assignment, you're just going to be looking at these two accounts down here.